Good morning, good afternoon, good evening, uh, everyone, and welcome to this month's edition of AML Voices brought to you by AML RightSource. I'm Elliott Berman, Marketing Thought Leadership Specialist here at AML RightSource, and I'll be your moderator today. We're thrilled you've joined us for today's Enhancing Your KYC Program session. Knowing your customers continues to be important as the financial crime landscape continues to evolve. Today, we'll explore KYC programs with innovative strategies, better tech, and a sharper risk-based approach to strengthening your financial crime prevention programs. I have an outstanding group of experts with me today. Darren Lopez, who's Vice President, Financial Crime Director, Customer Due Diligence, Currency Transaction Reporting, and Sanctions Operations at Fifth Third. He has a business card that's so long he has to fold it to get that title on there. Kevin Lee, who's vice president in the Financial Crimes Advisory Unit here at AML RightSource, and Stephen Falvo, who's vice president AML Sanctions Group Manager at PNC. All folks with a lot of experience in the space and insights to share with us. Before we dive in, I just want to give you a few housekeeping notes. Today's session is being recorded and it will be available on our website shortly after the event. And if you have a question, please use the Q&A feature to submit it. We'll address as many as possible during the session. And with that, let's get started. So I'd like to start and just level set the whole conversation for a moment. Clearly, we're going to talk about KYC. One of the things to remember about KYC is while there are some rules about it, of course, there's no single business model. And there are many variables, three key variables that I think you'll hear the experts touch on today is that drive your KYC program is what's your customer base look like? What's your company's risk appetite look like? And what's your company's business model? For those of you in smaller traditional banks, that can be very different from larger traditional banks. And for other non-bank financial service providers like fintechs, payment platforms, and things like that. So while we all have to deal with knowing our customer, how we go about that really is driven by those three factors at the top end and other factors as we go. So I'd like to start with kind of where we are now, and that doesn't mean, and then we'll go to forward looking, but again, where we are now in terms of the kinds of things people are doing from our experts' point of view, and which of those are sort of innovative. So, Darren, let's start with you, and then we'll go to Stephen. Can you talk about your institution's customer bases, risk? I mean, those three factors I just mentioned,
Yeah.
customer bases, risk appetite, business model, and how they influence your approach to KYC, CDD, and high-risk customer evaluations, and even subtypes of your high-risk customers.
Yeah, no, for sure. And thanks for having me, Elliott. But yeah, here at Fifth Third, our institution, is the CDD EDD program is really one of the pillars of financial crimes. So how do we approach CDD? It's a dynamic process. So I'll touch on that here in a second. But really, what I want to kind of build on is just the overall. This isn't a one-time event, right? This isn't. We see you at onboarding and then we never see it again. So here at Fifth Third, the way that we look at high and for us, we also have elevated risk customers. So we continue to monitor our customers, high risk annually, elevated risk every 3 years. But we also can trigger reviews based off AML factors like SARS, negative news, alerts in our investigations team. So not only do we have that annual and every 3-year process, we also have some dynamic scoring in the background that can trigger reviews at any point in time. So yeah, and just to add with that is, based off our definitions of high and elevated risk customers, right? Every review does not look the same. They're all different. I think one thing you asked about as well is the subset of our high risk customers. So I'll tell you my experience with other leaders at other banks, we're not too far off. I mean, to give you an example of some of our high risk customers, there's ATMs, service providers, third party payment processors, and then like I said, we have also another subclass of elevated risk customers. So that could be like your private banks and etc. So that's how we are designed here at Fifth Third.
And Stephen, talk about those same issues at PNC.
Yeah, I think similar to what Darren said, we're very similarly structured. So as we've built out the program, we focus on risk factors that are aligned with the customer's overall profile, their geography, and then some of the ongoing risk factors. Darren touched upon some of those, like negative news, SARS, PEP exposure, sanctioned events, things like that. And within each of those risk categories, we do have underlying risk factors that we also use to evaluate customers. We include legal entity type, occupation, industries. We also, again, it's a continuous process, right, in terms of evaluating the program and making sure that we're nimble enough to adapt to a changing regulatory environment as well as our own risk appetite. We have our stratification as with high, medium, and low. So high gets periodic refreshes at 1 year, medium is 3 year, and low is 5 year. And certainly interspersed within those statutory timeframes, we also have triggering events that can focus on some of those event-driven ongoing risk factors. As far as some of the higher risk industries, again, similar to what Darren mentioned, ATMs, third-party payment processors, MSBs. We've also incorporated within that certain products, cash logistics, for example, remote deposit capture, international trade, where we also have considered those higher products that have create a higher risk exposure, either because of their cash intensive or permit cross-border transactions.
Kevin, I'm going to come to you in a minute for a broader industry view, but Stephen and Darren, I wanted to go back to you and ask you if you could each talk about a meaningful change that you've made to your process recently, or that you're contemplating as we speak. Maybe it's in design or, in the pipeline, but not, still in test or something like that. And what prompted you to make that change? So Stephen, why don't you go first?
Yeah, I think one of the things that we're contemplating is just a continuous evaluation of the industries in which we have a higher emphasis on what I would call that pose elevated risk. And where we're currently working on is developing and evaluating some of the industry types that are focused in the FFIEC manual, as well as those that we already have internally, our products and services continuously as well, having to adapt to a changing landscape in how we onboard. We're less and less sometimes about those face-to-face interactions and more heavily dependent upon the digital channels, especially as the industry continues to expand in those areas. So we're working to incorporate those into the program. Again, working to be that nimble, take that nimble approach that we can adapt what we're doing. But two key areas: the how we're onboarding and how we're engaging and collecting the information that we need to form the basis that KYC, that we know our customer, understand the nature and purpose of relationship, and then also industry related, focusing on evaluating where certain industries we may want to take a closer look at.
Darren?
Yeah, I mean it's very similar to Stevens, right? Like we're always evaluating, AML risk. One that I'm kind of watching closely now is the arts market bill that's that's going right now that which could pull that, under a high or elevated or enhanced AML review. So yeah, the evaluation of that, and then as you grow, and that to Stephen's point, doing things quicker, faster, but still mitigating risk as well, right? As an operational leader, it's something that I always think about, like how can we do things just a little bit quicker, but also still managing the risk. So whether that's different onboarding tools, different periodic review tools, to really make it easier on my analysts, but also making sure that we're covering all the risk as well.
Kevin, as a consultant in our financial crime advisory team, you see a wider view of clients because you're in and out of, many clients as opposed to just, Stephen and Darren obviously having an in-depth understanding of their own processes and conversations with colleagues around so they're not in a total silo. But what are you seeing from a broader perspective beyond what we've already heard from Stephen and Darren?
Yeah. Thank you, Elliott. I think I will go back to something you kind of started the webcast on, right? Which is the, consideration that there is really no one size fits all model, right? I think with that in mind, as a consultant, my role has been to help clients right size their programs. It's balancing regulatory expectations, right, with the realities of really the three areas you touched upon: customer base, risk tolerance or risk appetite, and their operating model. I think it's important to really acknowledge that regulators don't expect uniformity from any of us, right? They really expect a risk-based approach, which has long been the approach that we've taken with respect to designing and implementing financial crimes and AML compliance programs. Um, and I think a lot of the areas that Darren and Stephen just touched upon are precisely what differentiates, right, between what might be a check the box KYC program versus a truly effective one. So as a consultant, what have I seen? In terms of customer base and business model, I've seen it really run the gamut. Institutions with primarily retail customers, for example, this could be community banks, it could be credit unions. They may focus heavily on elements like customer identity verification, as well as KYC controls that may be targeted at supporting, the transaction monitoring efforts for structuring. And structuring specifically because it's a typology that their business model and their customer base might, it's a typology that they will most likely see or see in higher volumes. Compared to, these retail customers, I've seen commercial banks and wealth management businesses that face more complex risk. These could be dealing with shell companies, cross-border transactions. They may have PEPs based on their global footprint. So their KYC processes tend to be more intensive. They tend to have a more developed and sophisticated EDD process to address these risk factors specifically that we might not see elsewhere. And then I think the last thing I'll really note from a customer and business model perspective is really on fintechs and crypto platforms. They often attract harder to verify customer segments. So I've seen a lot of those customers really drive investments in digital identity verification. They tend to be more interested in controls like geolocation screening. So again, no one size fits all. Really see different strategies at play across different customer types and different financial institutions.
Stephen, we had a question come in that was specifically for you. The fact that you mentioned that your low-risk customers receive a review on a 5-year cycle. The person sending in the question says they're interpreting that means you look at your entire customer base at a minimum of every 5 years. Um, they want to know if your high-risk reviews and your low-risk reviews are different, other than just frequency.
Yeah, that's a good question. So, yes, they're different. So, in addition to just the cadence at which they're reviewed, The high-risk reviews are also subjected to additional screening for negative news and PEP exposure through some of the vendors that we partner with. Additionally, they also receive a 12-month transactional review and analysis that's documented for them. So get a more frequent touch. And certainly some of the customers that do fall into the high classification, they are some of the industries and customer types that we talked about. So your ATMs, your MSBs, those generally do require a little bit more of a personal touch in terms of collecting additional information to form again that basis that we understand the customer. So there is more touch points in the high risk as well with the need to collect that information.
Stephen and Darren, you've both described the outlines of your program today. I want to dig a little deeper. So, Darren, I'll go to you. What are the kinds of things that are, as you look at your program, that really issues that are really top of mind? And I guess doesn't have to lead there, but we are going to talk before we finish up today about what you're looking to what are you thinking about for the future. And I think this is, presumably this in some ways will be connected to, things that might be on your roadmap or things like that. So, Darren, what's top of mind these days?
Yeah, I mentioned this earlier. It's really top of mind for me is the whole really onboarding process, being able to, do it quicker, more efficient, mitigate risk. I always use the example that, you can get a mortgage loan, on an app and turned around in, 20 minutes. Can we apply the, customer diligence and onboardings at that type of speed? Right. So it's the tool for me that is important and kind of top of mind. I would also say, very similar to what Stephen mentioned, is from a refresh perspective is really applying that same sort of tool, right? Because very similarly, we, have that, customer touch point or, banking center touch point at, those review cadences as well, and being able to get that information, quicker to the customer back to us, still with, getting all the correct data and all that information. So it's an easier customer experience as well, right? Because, a customer, I would assume is, doesn't want to keep going back and forth with their bank about, incorrect data or missing fields or whatever not. So those are probably the one or two that are top of mind for me.
Stephen?
Yeah, I mean, I think so. It's continuous focus on the program maturity and evaluating our methodology, taking into account how we can incorporate some of the advancements in the advances in artificial intelligence, how we can stay abreast of an evolving regulatory landscape. I think too that kind of fit into that are certainly focusing on the quality of our data. We are similar to what Darren mentioned, that the key to that is to make sure that we have a robust onboarding experience that ensures that we're collecting everything we need to execute downstream with a risk rating, with the enhanced due diligence, with any other measures that we want to apply to a specific customer, industry, or product. And then I think also we're looking for ways to leverage the channels that our customers are using to reach. So to reach them, we want to use the channels that they're using, which means that it's not picking up a telephone or using email or even using snail mail. It's using our online and mobile banking platforms to reach them, to have them refresh this information. We really want to, again, we tell people bank how you want. We want to come along for that ride and refresh how they want to, whether that's digital or in person. We want to give them options.
How are you thinking about continuing to move your program to be risk-based? So you mentioned earlier, and I think I hadn't hadn't really thought about a cycle that long of, your low risk customers only getting a refresh once every 5 years. To me, that's very risk based. Traditionally, I think we've seen a lot of 1, 2, 3 has been kind of the approach, or 0 for the super high risk that you're willing to take on, but you're really looking over their shoulder. And then 1, 2, 3. But what else are you doing to try to move your program to be as risk-based as possible, I guess I'd say?
Yeah, I think we leverage, we like to, again, continuously within the four walls of PNC, continuously evaluate the effectiveness of the program, take the lessons that we're learning as we continue continue maturing the program, hear feedback from our partners in the first line. And also, I think through industry advocacy groups like the Bank Policy Institute, that's a good forum to hear what others in the industry are doing. In a lot of these forums, we hear similar themes and similar challenges across the industry in terms of how do we continuously evolve the program. And I think for us, it's just continuing to look at how effective it is. So using those low risk customers, certainly 5 years is a long time between touches, but to mitigate the risk that if an event happens, we have continuous screening for PEP sanctions and negative news risk. Certainly, we have transaction monitoring scenarios that are running in the background to detect and have reviewed any questionable transactions. And then certainly, our lines of business have trigger-based events in their own workflow, as if they add a new product or service to a deposit account, for example, that they're updating and refreshing that information. So I think as we continue to grow, we'll look for continuous ways to do some benchmarking, continue to do our benchmarking, and look to adapt where we need to.
Darren, same question.
Yeah, no, I mean, we're always evaluating the program, right? And trying to stay up, is with what we're seeing out there. I'll say, for me specifically, it's really kind of, making sure CDD isn't that check the box exercise, and more moving probably towards a more trigger-based review cadence. Whether that's, changes made within the first line to, let's just say, beneficial ownership, or, maybe it's more enhancing some of the AML factors, in that, and really kind of driving the cadence of some of these, reviews that we're looking at today. So I would say that's probably where my mind kind of goes as far as like risk-based, is more kind of like triggering events. Again, whether it's beneficial ownership or, negative news or, AML factors.
And Elliott, oh, sorry.
Yeah,
Go
no,
ahead.
go ahead. Go, Kevin.
No, thank you. I was just going to add that, at least within the industry, I've also seen renewed emphasis on certain activities that will help institutions take that more risk-based approach that you referenced, right? So, for example, a lot of renewed emphasis on risk assessments, right? More comprehensive, more data-driven, to really get at, within my organization, where do we have risk exposure, be it AML, sanctions, fraud, whatever the discipline might be. And then beyond the risk assessments, also more data-driven, I'm seeing a lot more comprehensive metrics reporting, particularly around conversion rates, right? I mean, ultimately, the SAR requirement is one that we're all beholden to, right? That's one that we focus on a lot. So conversion rates even, be it from alerts to SARs, or even looking at which customer types or customer segments tend to result in more SAR filings. So those two areas I've seen a lot of, again, emphasis on to get at a better risk-based approach.
I'd like to ask all three of you, what are each of you seeing or doing in your KYC and general customer review processes related to the latest focus on de-risking from both the administration and, more importantly, for day-to-day operations from the regulators. Darren, you want to start?
Yeah, so from this is a tough one. So, de-risking, right, kind of goes against risk base, in my opinion. So, you know, um, it's tough. I mean, what we're seeing today is we're just navigating just a complex space, right? Of just trying to balance, everything going on in the world today. So I know not a great answer. It's challenging for sure.
Stephen?
Yeah, I'll echo what Darren is saying. It's I think it's something that I like how he phrased that de-risking is the opposite of a risk-based approach. So I think that's something that we, as an institution, we would, have certainly taken accounted for in the program prior to some of the recent developments, but within the current dynamic, I think we'll continue to just evaluate and work toward deploying measures that are appropriate for the institution.
Yeah.
Again, not a great answer, I know, but that's kind of what we're doing.
Kevin,
Yeah.
seeing anything different about?
No, my reaction is it's a very candid and honest response from Darren and Stephen, right? We hear it across the industry with respect to everyone really trying to figure out how best to prepare for, right, to respond to the executive order on debanking, right? And I think a lot of the advice and conversations that I've had with my clients have centered around, proactively reviewing their risk appetite statements, right? Any policies and procedures that pertain to client acceptance or client exit protocols. Really making sure that you also look at your governance forums, for example, your risk committee structures, specifically around, reputational risk or other risk domains, and to make sure that if you are not onboarding certain customers or if you are exiting certain customer relationships, that you fully have it documented in terms of on a case-by-case basis, your specific reasons for doing so, so that does not come across as, based on, factors and considerations that are frowned upon. And then I think beyond that, there are additional existing controls that a lot of institutions might have that warrant revisiting, right? If you have a blacklist, a lot of institutions do. Um, for the parties, for
Why
the
don't you explain, just for clarity, why don't you explain how you're using that
No,
term?
certainly. Blacklists, internal lists are compiled by individual organizations on, you know, individual names or parties that they do not want to do business with. Right. And this could be for a number of different reasons. And, each organization, each institution will have their own criteria. It could be something as simple as it was an existing customer that was exited previously for some reason and they don't want them to return. It could be that there's adverse media that was identified about these parties previously. And in terms of handling, let's say, screening volumes, they may be added to a blacklist that is screened against at the time of onboarding, right, to kind of prevent reentry. Um, but going back to the executive order and debanking, if you have parties listed on a blacklist, what was your documented reason for doing so? Do you have a good reason? It might be a good time to go back and revisit some of these controls that you had in place previously.
Uh, we had a good question come in, and I want to go to Stephen and Darren about this. Um, if your institutions work with non-bank financial institutions, how do you deal with the challenge of knowing your customer's customer? So, Stephen?
Yeah, excuse me. Yeah, that's a good question, and we recently addressed address this through the development and the deployment of a third-party access and third-party relationship procedure. So certainly NBFIs, a number of them fit within that within that categorization, and depending upon the tier in which they fall, it could run the need to collect a questionnaire from the customer as to how they are allowing or permitting the third-party access to PNC's products and services, or how their relationships are structured, to more of a, I'll call it a lighter touch. But we do have a formal designated process around third-party handling and access.
Darren?
Yeah, it's right. It's understanding your customer's customer. So it's it's truly understanding that our customer knows their customer, right? Either through like that light touch documentation or etc. And really just feeling comfortable that our customer knows their customer, really well. And then just again, having the governance around that and making sure that all your AML leaders, are all in aligned with, the way that we're doing those.
Do your organizations have special teams who are the business contacts for those type of clients, and who also, before that NBFI is onboarded, they understand what their responsibility is going to be in terms of sharing their customers' information with you so that you can know your customer's customer? Darren?
Yeah, in short, yes. We have a dedicated group within financial crimes that really that's their focus is that.
And Steve?
Yeah, there's teams in both the first line of defense and the second line. So the first line does sort of the intake of that from the frontline relationship teams, and then as needed, and as I mentioned, they will engage the second line, who is responsible for overseeing and governing that third party access. And as Darren said, the primary objective there is to understand our customer's customer and making sure that we have an we can adequately document that in our for purposes of due diligence.
I'm going to put you on the spot a little bit, guys. Do either of you get pushback from that first line group about, the customer, the NBFI we'd like to onboard, they'll take care of it, just, kind of trust me kind of an approach, as opposed to, or the NBFI basically saying, oh, we don't know how we're going to do that. Have you had that experience?
So I haven't had that experience, but that, like I said, that group is in the second line under financial crimes, and yeah, I'm sure that they get a bit of that for sure. Yeah.
Steven?
Yeah, I think I think that I haven't encountered that either. I think certainly that potential could exist depending upon how maybe lucrative or time sensitive that opportunity is. But again, within that within the process that we've stood up, there are some senior leadership approvals that are certainly required before you hit that go forward button. And that's a good, I think it's a good control to ensure that the due diligence is done before we proceed. And again, I think it was referenced earlier, this is all about providing a good and seamless customer experience. We don't want to find out 30, 60, or even 90 days later that this relationship isn't a fit for us. It leaves a sour taste in the customer's mouth, and certainly the last thing that any institution would want is someone to spread that through word of mouth.
Yeah.
Evan,
I think
what are you seeing in this space?
I I think from having worked in industry prior to consulting, and then also what I'm hearing now, you within second line, you will get a lot of pushback, and that kind of goes back to, well, we're asking for too much because our competitor down the street is asking for less to
Right.
onboard this customer. It is not true 99% of the time. And we know that because we have webcasts like this, we have conferences that we go to, and Darren and Stephen are smiling. We're asking for very similar requirements to onboard customers. We're asking for very similar requirements to onboard higher risk customers. So a lot of times it's just pointing that out to our first line stakeholders that we are here to partner and collaborate with you. Our intent is not to cause any friction with the customer. That being said, we are the experts in this space. We do talk. We do have professional industry organizations that we're a part of, and we know what we're asking for is reasonable. And I think sometimes it's just, almost calling the bluff, right, if you will,
Yeah.
to kind of manage that relationship.
I would agree. I would agree with that.
Yeah, and I think that, our competitors don't ask for as much. A version of that has been around for as long as I've been in the industry, which is a really long time. I can remember in my first in-house financial institution position, we in the law department would get the business people saying, well, that requirement's unfair. Our customer down the street does it this way. And our answer became, bring us the information that shows how they do it.
Right.
And then we can all sit down and figure out if we want to do it that way. But just because, someone said, well, if I go down the street, I can do it without that. It's like, that's not enough to make a program change, and take a bigger risk, or not really ignore evaluating the risk. So we've had some good questions come in. One is one of those interesting ops questions. So do you do OFAC, PEP, and negative news searches on new customers before their accounts are live, or like overnight or next day? So Stephen, Darren, how do your systems work these days?
Yeah, so from a screening perspective, the screening solution does that during onboarding for all three of those, and then certainly I think that it's also product based. Some of the products and services that are delivered to customers certainly have a longer runway in terms of application to closing or booking. And throughout that life cycle process from application to closing, there's screening done along the way. So example, like for a mortgage, for example, that certainly has a long runway on it. Things can change, as we all know, very quickly in that space. So that's done throughout that process. But and then there's also real-time screening done on transactions as well, for like ACH, Fedwire, things like that.
Darren?
Yeah, very similar to Stevens. I would say just from the AML side of it, as well as, as defined by our policy, AML high risk customers, they ultimately need financial crimes approval prior to onboarding.
Kevin, are you seeing a shift to, I guess I'd say, a run of scans prior to go live for the customer, whether it's a long runway customer like a mortgage, or a new, first through the door, a DDA account with a debit
Yeah.
card kind of, your basic customer entry.
Yeah, I think with our traditional banks and financial institutions, I still see, excuse me, the ability where it's being done predominantly prior to account opening, particularly OFAC screening, right, to comply with any requirements for blocking or rejecting funds, where I see a lot more focus and emphasis on trying to really accelerate that process and potentially doing it after the account open is on on digital platforms, right? Where again, I think Stephen mentioned this earlier, it's kind of customers banking the way they want to bank. And in a digital environment, they open their account, they want to be able to transact immediately, right? And customers don't want to wait because behind the scenes, you have an OFAC team that's trying to go through and clear whatever alerts, may have triggered that were
Right.
probably false positives. So I see this to be more of a challenge for, a lot of digital banking platforms and a lot of fintech firms that we speak to.
Yeah, and historically, I mean, all of you will remember, and many of our audience members will remember that OFAC screening uh, was an overnight in the batch process. So, and if you're opening a new account at 10 o'clock in the morning, there really wasn't, in the old days, there wasn't an option to actually get a current screen, ignoring all the things you just talked about, Kevin, which is, uh-oh, now I got a hit. Now I got to do something with it. But you couldn't even run it because that wasn't
Yeah.
how the systems were set up. They've obviously advanced significantly, kind of to Darren's point much earlier in our conversation, looking for ways to make things work faster but still be effective in their original purpose. So we've certainly been able to advance that on the OFAC side. But as you point out, the folks, and I'll use one of the buzzwords, the folks who have appropriately pushed the envelope on frictionless service providing. We still have the need to get some of these things done, and the question is, can we really get them done effectively? I have a question that I think I'm going to hold. I'm going to tell you what it is, but then I'm going to hold it because I know we're going to talk about the future, and that is think about how you're moving to perpetual KYC and what that might mean in each of your organizations, and Kevin, what you're seeing. But I want to do that in a couple minutes. Um, Stephen and Darren, somebody's asked a question about whether you rating ATM operator customers as high risk. Do you make a differentiation based on whether they operate one or two, or have a big business, or if you operate an ATM customer, does that move you to your high risk bucket automatically?
Yeah, I can take this. Yeah, they fall into that ATM bucket. It's kind of one size fits all. Though I really like the question because I've thought about this a lot lately, right? Should we be looking at, a grocery store that has one ATM, the same way as, 10 grocery stores, that have 50 ATMs, right? And again, kind of playing more on that risk-based approach.
Stephen, any difference there?
No, it's a similar approach. It's a one size fits all. But I really like what Darren what he said in terms of looking at it, stratifying it a little bit more and applying different measures based on the number of machines that's associated with the customer. If you're a servicer, things like that, you own 100.
Another question that came in is in the context of high risk customer refreshes, how do you deal with customers who uh, are resistant to filling out and returning questionnaires, providing updated documentation, things like that? Broadly speaking, in your institutions, what's the process there, or the end game, I guess I'd call it?
Yeah, I can. So I think with high risk, I think again, I go back to what I probably said two or three times, but I'll hang my hat on it always, is we have to understand the nature and purpose of our customer relationship, including how their current account activity aligns with their customer profile. And I think when we encounter customers that are certainly resistant to providing information, we have to treat, and we do treat each situation on an individual and case by case basis. And do we, at the end of the day, maybe we didn't collect a certain data element, but if we have enough to make an informed decision on that relationship, that's what our main guiding principle is in this space. So again, it's not really the opposite of what I just said about the ATM. It's not really a one size fits all. We have to kind of tailor it to the information that we have available to make an informed decision.
Darren?
Yeah, very similar, but at the end of the day, it's we have to manage the risk as well. So, it's definitely a balancing act. Right, we're trying to get everything that we need to do this refresh to mitigate the risk. But maybe there is, questions that were answered that we can leverage to then, mitigate that risk. But again, like at the end of the day, that, if there's a question that we need, we're going to work with the customer to hopefully get that answered.
Kevin, any other insights there?
No, I actually think Darren and Stephen hit it, right? That it's really on the case by case. And I think the key is to remember the objective of the activity and not to be tied down by, right, any prescriptive procedures, right? That there may be other ways to getting at the ultimate goal of knowing your customer.
Right. And some of that is in how you write your procedures. If the procedures say you must, to clear this customer or during the review to continue on, you must have these 5 things, and there's no wiggle room, then you're faced with that challenge that when the regulators come in, you end up with the challenge. You didn't follow your own procedures. There isn't, nothing bad happened, but, they're really testing you against your own procedures. So having flexibility in the procedure writing allows you to have flexibility to make, as each of you, Darren and Stephen, said, we're trying to be comfortable that we can make the risk evaluation. And as long as you have enough pieces of information and can document how you did it, that should get you there. But the prescriptive process or procedure writing can also be an unintended trap. So something to keep, just be thoughtful about. Can't be too loose, but if it's overly prescriptive, all of a sudden it's like, oh, I couldn't get, the blue card and now I can't say yes, kind of thing. And that's not good. When you guys do your refreshes, particularly, I guess I'd say high risk, but any of them, is that a first line activity? Is that a CDD team? Is it some combination? How do you actually structure that? Stephen?
Yeah, for high risk, there is a centralized team within our financial intelligence unit, part of second line, that completes that handles the refreshes on high risk customers.
Darren?
Yeah, it's the refresh of high risk customers and elevated risk customers sit within the second line under the customer due diligence team. But we partner very closely with the first line.
Yeah, that makes sense to me. Kevin, you seeing anything significantly different in other places?
I do not. I think the key is the partnering aspect, right? That to really successfully complete your periodic refresh for KYC, it should be a collaborative effort between the first and second lines of defense.
So as we look to the future, I guess the big billboard that's flashing all night long is crypto, stablecoin, all of these things. Lots of emphasis on it, both in the US and globally. Actually, John Byrne and I talk about that in this week's edition of This Week in AML because of the Genius Act and advance notice of proposed rulemaking, some comments coming out of Canada, the recent update to FATF's guidance. So how are the two of you looking at managing the risk of crypto related businesses, so providers, as clients, and also crypto activities by other clients. Darren, you want to say?
Yeah, I would say cautiously. Here we
Good answer.
yeah, very, very cautiously. We're in the very early stages of this, of course, as you mentioned with the Genius Act. We actually just hired a crypto risk manager to more explore in this space. I will also add that we just made a change within our customer due diligence policy that any VASP needs ultimately, excuse me, excuse me, chief risk officer approval. So it goes to the top of the house if from an approval perspective, but we're dipping our toe in it and we're cautious.
Stephen?
Yeah, I think we're taking a similar track. I mean, certainly there's a cultural shift, and it's created this evolution in digital assets that we have to kind of adapt to. So similar to what Darren mentioned, we're looking at that, developing and establishing a risk framework that will allow us to kind of tailor that approach to these newer technologies, offer certainly that AML, the protection for both the AML program and our customers. So we're looking to there's dedicated individuals within our advisory space that are working on developing a framework around that. Not it's I don't have much more detail at that point. I'm not directly involved per se, but it sounds like we're going to probably take a similar approach where certain ones may require a senior leadership approval.
So
Kevin, seeing anything different in the industry? I'm guessing you're seeing a few very early adopters who probably got out there ahead of a lot of the regulations and scrutiny. But what are you seeing?
yeah, I think what Stephen and Darren are really hitting upon with the activities and the preparation that their organizations have embarked on is really about awareness. And I think that's where every company needs to start, right? They're working on understanding where crypto may appear in their business, right? To really to identify any potential risk and how to mitigate them, right? And it's not a matter of just applying your standard KYC playbook. I think organizations really need to understand their business model. Are these customers or third parties issuing crypto? Are they running an exchange? Or are they just accepting crypto for payments, right? So for issuers, it may mean that you need to dig into things like their licensing and ownership, whether or not their reserves are adequate or independently audited, right? If it's a merchant that you're dealing with, do they, for example, a consideration may be, do they convert crypto straight into fiat, right, through a regulated processor, or do they actually hold it on their books? Because I think a lot of the answers to these types of questions really helps you identify the scope of risk that they may pose to your respective bank. And then the higher the risk, the more you really need to move into EDD. So it's going to be kind of the tried and true controls of reviewing their governance, right? Their AML controls. It may be deploying blockchain analytics to monitor any type of flows. Right. So for me, the key point is from a KYC perspective, the principles don't change, but the questions and tools now need to be tailored to specific crypto use cases as you identify them within your organization.
And the industry has done that for years as new customer segments have
That's
come on.
right.
I mean,
Mhm.
we're all not quite old enough, but I remember as a teenager when the first ATM, when a bank near me put in an ATM. There weren't real broad networks. It was just for that bank. But pretty quickly they became networked. And if you were a bank and dealing with any of the providers in that stream, all of a sudden you had a new industry that you had to figure out what were they doing. And we've done this over and over again. So while there's a lot of fanfare, if you will, about crypto and a lot of focus. It's another customer segment, and we just have to figure it out. And I don't mean to downplay it, but I think that part of the playbook is the same. It's
That's right.
understanding
That's
what
right.
questions you have to ask, what you need to learn about licensing, if licensing is a factor, all these different things. Your comment about blockchain analytics is interesting. New York DFS just came out with a strong recommendation to uh, institutions that are regulated by the New York regulator to include blockchain analytics in their in their processes when dealing with crypto service providers or others in the space. So I mentioned I was going to come back to this perpetual KYC or uh, concept. I think we'll sort of wind up on that. But Stephen, are you guys working or already doing in any segments what is being referred to as perpetual KYC?
So when I think perpetual, I think like we're talking about like instead of a statutory based refresh, we're talking about the different triggers, I assume. Um, and I
Or
think
ongoing? Yeah, I guess
yeah,
right, exactly. A triggering event or a triggering activity, right?
yeah, and I think one of the ways, one of the certainly one of the things that we need to get to that what I'll call a target state is certainly you have to have the data quality there to achieve that. And I think certainly as we work to enrich our customer profiles through these statutory refreshes, through the 1, 3, and 5 year cadence, I think we're going to ramp up to that perpetual target KYC. This way, it's something that becomes ingrained in customer behavior as well, and allows. We touched upon one of the questions I think was around, what do we do when a customer doesn't respond? Well, when you only get that request maybe every 5 years, it's sort of it becomes an annoyance to you. But maybe if it's done, change behaviors and modify them, that when you do certain events, you're going to get this. It helps to maybe collect that information, enrich the profile, and stay on that perpetual KYC track.
Darren?
Yeah, I look at it the same way. So, right, I touched on this earlier. It's really just that trigger, you know, event triggered events, whether it's, through risk indicators, through, changes in beneficial ownership or et cetera. Also maybe it's, alerts from investigations, right? That, they're looking at it, different anomalies as it relates to transactions. But yeah, it's the trigger based concept and the perpetual KYC. It's I I think it's the way of the future. It's instead of the 1 year, 3 year, 5 year, or however your bank is doing that. Um, but it's to Stephen, I think he brought up one that I wasn't even thinking about. There's challenges with those as well. Is it, we kind of are on these cadences, and we're collecting information. We know we're going to get that information, whether it's 1, 3, or 5. Where this is really on the back end of it, and making sure that things are changing. And he touched on this is the data quality, and what we're getting is accurate and usable.
Kevin,
Yeah.
what are you seeing on perpetual KYC? And I'm going to interject before you have a chance to answer, and that is, when I talk to people about perpetual KYC, data quality comes up really quickly.
Yep.
Because if that's what you're going to rely on, sort of the systems gathering and then popping up another kind of alert effectively that has to be dealt with, you need really high quality data, and data quality is always a challenge. So, Kevin.
Yeah, I absolutely agree with Darren that I believe PKYC is the future, right? Especially as we move towards, really allocating resources and staffing and energy and efforts toward higher risk areas. It becomes important, right? In terms of managing some of those volumes that come up that may be non-productive. I'm going to sound like a broken wheel, but data is what I hear from everyone as well. And it's not a secret that data is critical because you're looking at, the data you obtain from your customer that may be self-reported, right? Now, you're also looking at data that may be publicly available, where you're going out to external resources. And then clearly, you're looking at, transaction monitoring activity as well. It's a lot of data that you need to pull together into your really ecosystem to make sure that you have a truly effective PKYC system with the right triggers, right, with everything firing when they're supposed to. So it's a pretty large undertaking. And I'm seeing that organizations are learning that it's really a journey and it's not something you really implement overnight.
Agreed. Well, we've come to the end of our time. I want to thank each of you for your thoughts and insights and your practical guidance. This has been a great conversation. Thank everyone who joined us today, and we hope that you found the discussion valuable and thought-provoking. If you'd like to revisit this session, check our website about a week out, and it will be there. Go to the resources tab, webinars, and you'll be able to find it there. In October, we're going to have a session on AML compliance best practices, and that'll be October 23rd, starting at 1 p.m. Eastern Time. You can register for the October webinar and check out all our other resources at our website, amlrightsource.com. On behalf of all of us here at AML RightSource, we want to thank you again for being with us. We'd like you to stay safe, stay compliant, and we'll see you next time on AML Voices.